It was 2 in the morning when my phone lit up. No voice message, no preamble, just a signal. The kind my brother only sends when he has run the numbers so many times from so many different angles that he cannot wait until sunrise to share what he is seeing. The message said four things: gold at 5,000, ratio at 57, Fresnillo just cut, silver goes to 300. I sat in the dark for a full minute and did not move, because those four data points, stacked together, read in sequence, are not random. They are a specific configuration, a pattern that serious commodity analysts recognize the way a chess grandmaster recognizes a checkmate setup 6 moves before it happens. And when my brother sends a message at 2 in the morning that reads like a configuration, I open my laptop immediately. What I found in the 3 hours that followed is what you are about to hear. And I promise you this, by the time this video is over, you will never look at the price of silver the same way again. Welcome. I'm AG Jack OG, analyst, strategist, and yes, the brother of AG John OG, whose work on monetary realignment, geopolitical capital flows, and the hidden mechanics of global markets has built this community into one of the most analytically serious rooms on this platform. We share the same obsession, finding the signal before the crowd finds the headline. If you are new here and you want to understand how real money actually moves, not how television explains it, subscribe right now. You belong here. Now let's decode what my brother saw at 2 in the morning. Today is February 28th, 2026. Silver is trading at approximately $92 to $94 per ounce. Gold is at $5,246. The gold-silver ratio sits at 57 to 1. And if you understand what each of those numbers is telling you independently, and then what they are saying collectively when they appear at the same moment in the same market cycle, the $300 thesis stops looking like speculation and starts looking like arithmetic. Let's build this from the ground up, because context is everything. 14 months ago, silver was trading at $29 per ounce. 13 months ago, it broke through $50 for the first time in history, a level that had stopped 2 of the most dramatic precious metals rallies ever recorded. In 1980, silver hit $49.45 during the Hunt brothers' attempted corner of the market. In 2011, it reached $48.70 before collapsing. $50 was the wall, the ceiling, the number that ended silver rallies. Silver walked through it like it wasn't there. By January 29, 2026, silver had set a new all-time nominal high of $121.67 per ounce, a gain of more than 300% from where it started 14 months earlier. And then, in one of the most violent corrections in commodity market history, the CME raised margin requirements 3 times in less than 2 weeks, forced leveraged traders to sell, and silver crashed 33% in days, from $121 to the low 60s. The mainstream narrative called it a blow-off, a speculation bubble, the end of the silver story. The data said something completely different. Here is the first piece of what my brother sent me. Gold at 5,000. Gold closed Friday, February 27th, 2026, at $5,246 per ounce. That is not background information. That is the anchor of the entire silver thesis. Because gold and silver are not independent stories. They are chapters in the same book. And gold at 5,000 is a chapter that has never been written before. Every major institution has now upgraded its gold forecast to numbers that would have seemed hallucinatory 3 years ago. JP Morgan has raised its year-end 2026 gold price target to $6,300. Yardeni Research projects $6,000 by year-end. Goldman Sachs targets $4,900. The World Gold Council published research just 2 days ago, on February 26th, warning that gold remains strategically under-owned relative to global equities and bonds, and that the institutional reallocation toward physical precious metals is still in its early stages, not its final innings. What does that mean for silver? Everything. Because silver has never in modern history staged a major bull market without gold leading the way. Gold at 5,000 is not just a number. It is a structural signal that the monetary conditions, the dollar credibility erosion, the fiat currency debasement, the sovereign debt crisis that is playing out in slow motion across the Western world, have reached a severity that forces serious, institutional capital into hard assets. And when that capital moves into precious metals, it moves into gold first, then silver. Always. Without exception in recorded market history. Gold just cleared 5,000. The clock on silver's next major move is already running. Here is the second piece. The ratio at 57. The gold to silver ratio tells you how many ounces of silver you need to buy 1 ounce of gold. Right now that number is 57. 1 year ago it was above 100. Think about what that compression means. In less than 12 months, silver went from being historically cheap relative to gold to approaching its historical average trading range of 40 to 67 to 1. Bank of America's head of metals research, Michael Widmer, has published what is now one of the most discussed institutional commodity forecasts in years. His $309 silver target for 2026 is not a guess. It is a ratio calculation. Widmer applies the gold to silver ratio low from the Hunt brothers era, 14 to 1, to the current gold price near $5,000. 14 times 100 equals 14. 5,000 divided by 14 equals 357, which is where 309 comes from on a slightly different gold price basis. Now, and this is critical, Widmer himself does not say $309 is guaranteed. He says it is the ceiling of the range based on an extreme historical ratio compression. His base case, using the 2011 ratio low of 32 to 1, still a historically aggressive level, produces a target of $135 at current gold prices. And his thesis for why any of this is possible rests on the same structural foundation that the supply data has been quietly building for years. But here is what makes the ratio more than just an academic exercise right now. The ratio has moved from 100 to 57 in 12 months. That is a compression of 43 points. In previous silver bull market cycles, ratio compressions of this magnitude did not stop at their halfway point. They ran to exhaustion. They ran to the historical average and then past it, into historical extremes. The 2011 cycle ran the ratio from 68 all the way down to 32, a compression of 36 points. We have already compressed 43 points from the high and are still above the historical average range. If the current cycle follows the pattern of previous precious metals bull markets, and there is a strong structural case that this cycle is fundamentally more powerful than 2011, the ratio compression is not over. It is pausing at a natural Fibonacci retracement level, gathering energy, preparing for the next leg. Here is the third piece. And this is the one that made my brother send the message at 2 in the morning. Fresnillo just cut. Fresnillo plc is the world's largest primary silver producer. Not one of the largest, the largest. When Fresnillo moves its production guidance, every serious precious metals analyst on Earth pays attention. And what Fresnillo did just weeks ago is extraordinary in its implications. The company officially cut its 2026 silver production targets from a previous forecast of 45 to 51 million ounces down to 42 to 46.5 million ounces, a reduction of approximately 8 to 10% at the guidance midpoint, from the world's largest silver miner. In a market that is already running its 6th consecutive year of structural supply deficit, in a year when industrial demand from solar panels, electric vehicles, and AI data centers is still expanding. The Silver Institute has confirmed that the cumulative deficit in the silver market over the last 5 years has reached approximately 820 million ounces. Nearly an entire year's worth of global mine production has been consumed beyond what the Earth has produced. That metal came from somewhere, from recycling, from liquidation of existing stockpiles, from the drawdown of COMEX and LBMA registered inventories that have fallen dramatically from their peaks. But stockpiles are not infinite. They draw down to a level where they can no longer serve as the buffer between supply deficits and price discovery. And every major analyst watching physical silver markets is asking the same question. How much buffer is left? When Fresnillo cuts production, the answer becomes clearer. And it is not a comfortable answer for anyone hoping this story resolves itself quietly. Now let's connect all 3 pieces into the picture my brother saw at 2 in the morning. Because separately, each data point is interesting. Together, they form something that is genuinely difficult to argue against. Gold is at $5,000. That tells you the macro environment, the monetary conditions, the sovereign credibility concerns, the institutional flight to hard assets, is more favorable for precious metals than at any point in 40 years. The gold-silver ratio is at 57. That tells you silver is not yet historically expensive relative to gold. It is approaching its historical average range, not exceeding it, which means the trade has not yet reached the phase where it becomes crowded, overvalued, or exhausted on a relative basis. And Fresnillo just cut production. The world's largest primary silver miner just told the market that less silver is coming than previously expected, into a market that was already structurally short of supply. These three conditions have never all been true simultaneously in a modern precious metals cycle at the stage where silver sits today. We are not at the end of this story. We are at the chapter where the reader starts to understand what the whole book has been building toward. So where does $300 come from in a way that is grounded rather than fantastical? Bank of America's Michael Widmer reaches it through ratio compression. Macroeconomic strategist Tom Bradshaw reaches it through a 45-year cup and handle chart formation on silver that just broke out. Citi's commodity team, which published a $110 target for the second half of 2026, bases it on acute physical shortage in deliverable silver markets. Robert Kiyosaki and Mike Maloney, who are less institutional but have been correct on the broad direction of precious metals for years, are using monetary debasement math, calculating what silver needs to be worth for hard assets to recalibrate against the extraordinary expansion of global fiat money supply over the last 15 years. Every model uses different inputs. Every analyst approaches it from a different angle. But the range they are converging on, from $100 at the conservative end to $300 at the historically extreme end, reflects a genuine market reality. The silver market is priced as if its structural deficit is temporary, as if supply will normalize, as if industrial demand will plateau. And the evidence, building in every supply report, and every production guidance cut, and every lease rate, and every Fibonacci level, and every ratio compression, is that none of those assumptions is correct. The market is wrong. Not about the direction. It has already moved dramatically in the right direction. The market is wrong about the magnitude, about how far this goes when the final chapters of the story are written. Here is what I want to be honest with you about, because this channel was built on analytical integrity, and that does not get suspended when the thesis is compelling. $300 is not a guarantee. It is not a base case for every analyst. JP Morgan's published average for 2026 is $81 per ounce, and their quarterly breakdown, 84 in Q1, dipping to 75 in Q2, before recovering to 85 in Q4, reflects a far more measured and cautious view than the ratio compression and physical scarcity models suggest. The Reuters consensus forecast sits near $79.50 for the year. There are real risks. Manufacturers are actively researching ways to reduce silver loadings in solar cells, a process called thrifting, and even small reductions in silver content per panel, applied across hundreds of millions of panels, could meaningfully reduce demand. A strong US dollar, driven by Kevin Warsh's more hawkish approach to Fed policy as he prepares to take the chair in May, could suppress precious metals broadly. And another CME margin intervention, if silver prices surge again toward triple digits with speculative positioning reaccumulating, could repeat January's forced liquidation at a higher price level. These risks are real. Anyone who presents the silver bull case without acknowledging them is doing you a disservice. But here's the thing about risks in a market with a 6-year structural deficit: accelerating industrial demand, production cuts from the world's largest miner, gold at $5,000, and a ratio still above the historical average. The risks modify the timeline. They do not change the destination. They determine whether silver reaches $300 in 12 months or in 36. But they do not explain away the math that says 300 is where the ratio and the supply data and the monetary environment are pointing. My brother does not send 2 in the morning messages about timelines. He sends them about destinations. And the destination, on every model he ran, on every angle he approached it from, kept producing the same number. I want to hear your reasoning directly, not a hope, not a cheerleader comment, your actual thought-through analysis. Do you believe the structural case for silver reaching triple digits is as strong as the supply data suggests? And what is your read on the $300 thesis? Is it ratio math for an extreme scenario? Or is it genuinely the logical endpoint of 6 consecutive years of structural deficit combined with accelerating industrial demand and a fractured global supply chain? Write it in the comments. Specific. Reasoned. The thinking that happens in this comment section is one of the most valuable outputs this channel produces, and I mean that without any performance in it. Sharp minds stress testing each other's analysis publicly is how serious investors sharpen their edge before the market moves. My brother was awake at 2 in the morning because the numbers would not let him sleep. After 3 hours at my laptop, I understood why. The question now is not whether the silver story is real. The question is whether you are reading it before or after the rest of the world figures out what the signal says.